Welcome, everyone, to this webinar presentation of Grove Parkview Apartment Homes. I'm Nkem Izamama, and I'm an ER physician. I am based out of Nashville, Tennessee, and I'm the CEO and founder of Phoenix Capital Investment. And I am really, really excited to share this investment opportunity with you. But before I start, I just wanted to say thank you. Thank you to everyone who has supported us at Phoenix from the start. It's so amazing to see the turnout of just people here tonight and to see the support. So thank you for those who have been here from the beginning. And then for the new faces, welcome. I'm really excited that this is something that you are excited about and that you want to jump into. My ask today is that you don't hold back. Ask me any questions as I delve into this presentation. Use the chat, use the Q&A. I'll make sure that I get to every single one of it. So how did we get to Grove Parkview? Before we found this deal, our last deal that we closed at Phoenix was last year. It was July of 2023. And since then, we have been looking for another great opportunity. We reviewed over 1,000 deals. We underwrote hundreds. We underwrote a ton. And we didn't find the right one until we saw Grove Parkview. And I remember when I received the financials from our partners, my team and I, we immediately underwrote it. We stayed up all night and we underwrote it and the deal made sense. And so collectively, we put the offer in and we got the deal. And it was so exciting. But what's more exciting for me today is to delve into the numbers with you and walk you on the journey of how we got here today. So for those of you who are ready to go here, this is something that I want to jump into. And if you're considering being part of our ownership group, I'm going to put our link. One of our team members is going to put a link in the chat. Go ahead, click on it and sign in. All you're going to do is sign in to the top right-hand corner and create a profile. And then one of us will reach out to you. We'll walk you through the whole process. We'll answer all the questions that you might have, and then we'll go from there. So before we start, I have to tell you guys this disclaimer and this disclosure is that I'm not a financial advisor or an accountant or a lawyer. My goal today is really to present this information to you and then for you to do your own due diligence and to do your own research. Most of you are on the Phoenix community, so you've gotten the investment deck, you've gone through our website, and then you get a recording of this. So all of that put together, kind of use that, make a decision. So the question that should be on your minds today is, how did I get here today? How did ER physician come to talk to you about real estate investing? And I'll tell you, it's a bittersweet story. And it started with around COVID-19. COVID-19 was very hard for us as professionals, especially in the emergency room. There were a lot of times that, we went through lost wages, we went through lost jobs, and our pay structure changed. And what do I mean by that? At some point before COVID, full-time was 120 hours, and some of us were working even more than that. You could work whatever you wanted. And at some point during COVID, our hours were dwindling, and it went all the way down to maybe 60 hours a month. And a lot of my colleagues almost felt like they were living to paycheck, and they couldn't afford, their livelihood. So they had to get 1, 2, 3, and someone even got 4 additional jobs to get them through this. And so it just hit me that we as high income earners, if anything changes so rapidly, we would be significantly affected. And even in that period of COVID, one of my closest friends, closest colleagues lost her job, and she wasn't the only one who lost her job. And so it just kind of hit me really hard. And even the hardest part was that our pay structure changed. In the ER, initially we were salary, and then it became you eat what you kill. And so we were almost fighting against each other to make ends meet. And COVID really taught me that I could not rely on one single employer for my source of income. And that was the beginning. That was the start for me to start figuring out, what does passive income mean? How do I build wealth outside of my 9 to 5? I needed to find a way to really grow and diversify wealth. And I knew that I needed to start as a passive investor. And so I remember sitting in a webinar just like this, just like you are. And that's how it started for me. But I quickly realized that real estate was the way to really build wealth and to preserve my capital and get a really good return. And that's how Phoenix was born. It was created with a mission in mind to really help healthcare professionals really build wealth outside of their 9 to 5 and really take back ownership, which I know that we're capable of. So just like that, we built Phoenix, we invested in 3 deals. And I told you that our last purchase was last year. And so Grove Parkview is our next investment opportunity. And I'm just really excited that I get to partner with you guys. A lot of you have been on the sidelines and you've been asking, when is the next deal? When is it coming up? Tell us about it. And so I'm really excited to really bring this opportunity to you and really start thinking about how we can grow wealth together. And so this is where we are. This is what we've done so far. And I remember being a newbie investor. I was afraid. I would ask, what if this, what if that, what if this happened? What if I lose this? But what I did, which I implore a lot of you here to do, is I did research. I learned, asked questions about the investor group, the operator group. I joined webinars like this. And when I felt like I knew enough and I felt like I could take a calculated risk, I leapt. I decided that I was going to start investing. And that's how I got here today. And so I'm really, really excited, to add Grove Parkview to our portfolio. But it started with just making that decision in the beginning. That was truly the start for passive investing for me. And to see the community that has formed out of Phoenix Capital, it's been nothing short of amazing. And we are we're empowering individuals, healthcare professionals, busy professionals to go out and build wealth and to create passive income. And it's just been amazing. So that's what's been the most exciting for me. But let us jump into this amazing opportunity, what this deal is really about and why we love this deal at Phoenix. That's me at the property. And the excitement on my face is the sunshine, but also just the opportunity to be able to bring this to you guys and to be able to acquire this property. So Grove Parkview is a 268-unit apartment complex, and it is in Gwinnett County, which is one of the fastest growing counties in Georgia. In the last 3 years, about 20,000 people have moved into Gwinnett County. And I think in the last about 13 years, 178,000 people have moved into that sub-county, into that county specifically. And it's in a submarket that is significantly growing. There are about 25,000 businesses, and it's doing really well. But what we love the most, or one of the things that we really love about this property is Grove Parkview High School, Parkview High School, which is what Grove Parkview is zoned for. And US News and World Report has reported it to be one of the top high schools in Georgia. To be able for Grove Parkview to be able to be zoned in that area is just really amazing. And so all of those reasons are just the tip of the iceberg as to why this isn't just an amazing opportunity. And I'm going to break down the numbers with you. I think, to me, it's really good for an investor to really come to terms and to understand what they mean. So this is a highlight of what we're offering. I told you that it's 96% occupied and it's still increasing. In the last 8 years, occupancy has been around 93% and it's been doing really well. And that is truly due to the limited supply and just population increase and demand and how thriving the location is. It's a very desirable community that people really want to live in. Our plan is to hold it for 5 years. We're also assuming an existing loan with an interest rate of 4.74%. And if you're looking in the market, you know what interest rates are today. If you're trying to buy a single family home, it's it's inching past 7, almost 8. And if you're looking to buy, commercial or multifamily apartments, it's 6.5 and above. So when we think about how exciting we're getting it for 4.7, it's truly exciting to us. But more important as an investor is, what do these numbers mean to you? So as an investor who's investing, let's say you're investing $100,000, your average annual return over the life of the deal will be anywhere from 15.5% to 18%. And those numbers are pretty conservative. And we'll go through the numbers in a little bit more detail. But if you do that, you're expecting to get about 1.5 times to 1.8 times your total investment. Now, what does that really mean? So in the deals we've done in the past, we've only had one type of structure, and we're bringing in 3 different types of structure this time, just because we've listened to our investors and kind of are thinking, what do they want? How can they benefit more from investment opportunities like this? So the first one is a Class A share. And those are investors who just want cash flow. So they're going to get a 10% preferred return, but they don't participate in the profit share. So basically, if you invested $100,000, and I'll use $100,000 today just for easy math so that we're all on the same page and you can like carry over. But so if you invested $100,000, you would get a 10% preferred return on an annual basis. And the minimum investment for that is $100,000. So you might be asking, like, what is preferred return? For those of you who don't know, when we get cash flow from the property, the preferred return is the number that is met to the investors before we, as the operator, we get any compensation at all. And we do it that way is that it really protects your interest and it incentivizes us to really perform on the deal. So moving on to Class B. Most of our investors fall in the Class B equity structure share. And that is a 6% preferred return. And after we hit that, it's an 80-20 profit share split. So 80% goes to the investors and 20% comes to us. And the minimum investment for that is $50,000. And then Class C is a new class that we're instituting for this deal. And basically, it's for larger check investors. They want to make a bigger risk, and in that, they're going to get a bigger return. And so we are looking at a 7% preferred return for them, and then the split for that is 90-10. And if you think about it, if you risk more, you should absolutely get more. And so the minimum investment for that is $50,000. So before we brought this webinar to the general public, we talked to a lot of our investors in our community. And so we've presented this. So some of the things I'll talk about are questions that investors have asked because they really want to understand the partnership structure and really how it works. And so in explaining the waterfall structure, one of our investors asked, what is the motivation behind the 80-20? And like, why are investors really getting 80% in the split? But the truth is, if you think about it, like you are investing your hard-earned capital into this deal. And so you should get a significant amount of the returns. And we structure it this way at Phoenix so that the investors are protected and they're also incentivized. So if you get 80% of the returns, you get that until we meet certain return metrics. And when we reach certain return metrics, then, and in those return metrics, if you're able to double your investment in 5 years, which is our hold period, then we feel like we've done really well. And then the structure will change to a 50-50 split. And that just, like I said, that just reiterates the fact that we feel like we've done a good job. And then we can also get paid. And so that 50-50 split looks like an internal rate of return of 16% for Class B and 18% for Class C. So that's just a way to think about the hurdle structure on the next level. And this is an overview of everything that I kind of just talked about, but I want to hit on the capital stack right here, which is, what happens to cash flow. So after, like I said, after income comes in, expenses go out, we have a net operating income. After that, debt is the first thing that's paid. And then after that, the Class A shares, those people who only want preferred return, who will not partake in the profit sharing, they'll get their distributions first. And then after that, B and C get their distributions, and then the operators get their distributions. That's really the breakdown of the capital stack. And then over to the left side, it's just a breakdown of everything that I told you based on the class structure. I want to jump right back into our business plan. Another question that an investor asked, which is, what is your renovation plan? How do you plan to go in and, with your value add strategy, how do you plan to improve the property and thus improve the cash flow and the returns to increase the value? Because that's exactly what we're doing. And our plan is to go, and we have two plans. We have an exterior renovation plan and an interior renovation plan. Our approach is that we're going to go in and we're going to create a better living, vibrant condition for tenants. And when we do that, that really translates to return for the investors. And the prior sellers, they did a fantastic job on the property. And so we're just going there and continuing what they did. So for our exterior renovation, we are planning to include a dog park as a way to bring in additional income because everyone owns dogs. And then we're going to go and really upgrade the pool area. We're also going to go in and upgrade the playground, what's there right now. And we plan to also improve the car wash area. We're gonna hit on the roofs. We'll do HVAC. We'll do a bunch of things to really improve the exterior of the property. And then our main plan is what we're doing on the inside. So we are going to be renovating about 105 units. And our plan is to take the classic structures, what they look like, what those initial apartments looked like in 1989, and then renovate them to today's standards, so to a premium renovation. And that is what our plan is. And we're doing that for about 105 units. Now, normally, when we do this, we look at comparable apartments in the area, and then we see what like those renovations are getting, and we use that as a plan. But we already have a proven strategy at Grove Parkview already, because the prior sellers have renovated about half of the units. So we have been able to go in there and see what they've already done, and they've already gotten a rent bump, so like a rent premium of anywhere from like $250 to about $400 in renovation. So we're going there and we're going to be able to capture a lot of those renovations. So we see the opportunity that it's there. We're going ahead and we're doing it. And at the end of the day, you know, our plan is to make it a nicer place for the renters, you know, for the renters to live in. And then that, like I said before, it translates to a higher net operating income, and the investors are getting more cash flow. So that is kind of how we're thinking about it. And by the time we do that, the renovation plan, by the time we go in and renovate those 105 units, that translates to an increase in the property value of about 20 million. So it's absolutely worth it to like go and start doing these renovations. And we plan to start it as soon as we acquire the property. When I was at Grove Parkview, with that picture you saw, during due diligence, we looked at the studio apartments and the one-bedroom apartments. And we noticed that the size difference between the square footage between the studios and the one bedroom, they were not significantly, it was not that much at all. So we are planning to actually go in and like really, one of our renovation strategy would be change some of the studios into one bedroom and be able to generate that additional income from the one bedroom. So those are some of the things when we put these numbers at you, that's the reasoning, that's our thought process behind what we're doing. And then we'll delve into finances. So the cost of the property is $49.1 million. Our loan amount is $31.5 million. And that's a loan to value of about 64%. What that means is that we're taking less leverage on the property, which makes the deal less risky. So we are bringing a significant amount of equity into the deal, which, like, again, I said, it just makes it a less risky deal and a safer opportunity. We talked about our interest rate is at 4.7%. We're going to hold it for 5 years. Our mortgage financier is Fannie Mae, and that's who we're borrowing from. So I want to spend, this is a kind of busy slide, but I really want to spend some time talking about the next two slides, which is how we made the assumptions we made and how we think we're going to increase the value of this property by as much as we did. If you notice, in the last 3 months, the vacancy was about 2.7%. And so like even in the last year, vacancy has been around 4 or below. But we are going in year zero at time of acquisition. We're saying that vacancy is going to be at 6%. We're underwriting for a 6% vacancy. But even more, when we start doing our renovation and our value add, we're actually factoring a 7 to 8% vacancy, which is making the deal more conservative. Once again, I'll get your attention. In the last 3 months, the last quarter, the gross potential income on the property has been over $5 million. But we're going in year zero and we're projecting $4.8 million in the first year. And that's just telling us, once again, how the assumptions that we're making and how conservative they are. We are factoring a 3% rent growth, but we're also factoring a 3% expense growth. And so what we're saying is that like the property will not grow organically. And all we're doing is we're going to focus on force appreciating the property. And so when you delve into the numbers deeper, that's what you're going to see. Those are some of the assumptions that we're making. And one of the conversations we had with our property manager, and I'll share who they are with you towards the end, we went in and in the last quarter, the property has been doing a 3% year-on-year rent, 3% rent growth. And so over the last year, it's been about 6%. But like I said, we kept it at 3% because we really wanted to be conservative. I underwrote this deal myself. And I'm a very conservative underwriter. And so when these numbers matched my numbers, it just made me realize that like it truly is a really good, really, really good and secure deal. And so this is our financial analysis. This is the second thing I wanted to bring to your attention, which is saying that, the way we generate income in this property is that we find ways to increase the income and decrease expenses. And so with our value add strategy, our renovation plan, we're going in, and between year 0 and year 5, we're saying that we're going to increase the net operating income of the property by about $1.1 million. And that will translate to about a $19.6 million increase in the value of the property. So that's kind of when we think about what we're doing from a financial standpoint, that's what we're doing. And I think this slide is also pretty important as for an investor to really understand when we are going into a deal, we really try to stress test the deal. So we look at best and worst case scenarios, and we see what the cap rate, we see the cap rate that we're buying at and what we're selling at. So if you remember one of the first slides I put up, I told you that the cap rate that we're purchasing at was 5.3%, and we are going to be exiting at that same 5.3%. But CoStar, which is a nationwide data source and any real estate investment firm really trusts what they say, they're projecting that we're going to exit this at a 4.6% cap rate. So that light blue line. And I wanted to put this slide, and this slide is just specific for Class B investors. But you can see what happens really when the market gets looser and cap rate increases, and what happens if cap rate starts to drop and starts to come down. You can see how much better your projections are going to be and how much higher, our exit price is going to be, which is like more value in the property, and that, gets returned to the investors. So when you think about it, like a simple way to think about cap rate is that when we lower the cap rate, we increase the value of the property, and the higher the cap rate, we lower the value of the property. So we're saying we're going to stay about flat, but CoStar is projecting 4.6%. So we're really excited, and that's how we're looking at it moving forward. So if you looked at the 5.3% cap rate, those are the numbers we projected, which equates to a 15.5% average annual return for Class B investor and about an 18% for Class C. So what does all this mean? And Cam, give me real numbers. So we created, the next 3 slides are just really sample investment numbers that you'll see. I told you for easy math, we always use $100,000, but for Class B, the minimum is $50,000. So if you went in and you said, I want to be a Class A investor, I'm investing $100,000, you see that 10% pref, the 10% preferred return, which equates to $10,000 every year. So your distributions are every year. You get the same thing, and you always get return of your capital. And that's where we get the $150,000. So you go in at 100, you come out at 150, which is an equity multiple of 1.5 with a preferred return of 10%. And then this is a sample Class B investor where you're going to get a pref of 6%, which we are getting as distributions. And then after that, like I said before, you're getting a return of your capital. Plus, this is that profit share line. And if you remember in the previous slide, for the Class A investors, it was 0 because they're not benefiting in that 80-20 split. And then after that, you would get, by the time you get all of those, plus all the distributions you've gotten, your total return on a $100,000 investment is $177,519. And that's where the average annual return of 15.5% comes back on a yearly basis over the hold period, with a preferred return of 6%. And if you put in 100,000 and you get 177,000 back, it equates to 1.78 times. And then this is the same thing for Class C investment so that you're able to see it. Okay, so this is, a lot of people have asked, and a lot of investors have asked, what are some of the tax benefits that we're getting in this deal? This is one of the greatest things about investing in multifamily apartments is that you not only get cash flow, you also get appreciation, but then you also get tax benefits. So imagine if you invested $100,000 in the property during the first year. and you're getting cash flow, which is coming on a quarterly basis. And then at the end of the year, you get a tax return that says you got $27,000 in paper losses. That is how powerful investing in this asset really is. But you're asking, like, how is that possible? And it's possible by something called bonus depreciation. So there was a law that was passed a few years ago by President Trump, and it allowed real estate investors to claim depreciation losses that a building had over time, to be able to claim all of that in year one. So what that means is that when we buy the building, we have a cost segregation expert. They come and they depreciate the value of everything in the building. The only thing that they don't depreciate is the land and the actual physical structure, but everything else is depreciated. And that is done every time that we acquire a new property. So every time you join in the ownership group, you get these tax benefits. So in the past, that was supposed to be claimed over 27 and a half years for residential real estate, but now we can claim all of that in the first year. And when the law was passed, you could claim like the full 100% the first year, but that is slowly phasing away. And that's why I have only 60% here, because it's currently at 60%. And so if you invested 100,000, you would receive 27,000 in depreciation benefits, and that equates to 60%. And so and the cool thing about this is that you can apply this to all your passive income. So not only the cash flow that comes from this property, but if you're in any other investment opportunities that is producing passive income, these depreciation benefits can actually go to those passive income as well. But also, because it just keeps getting better, there is a law in Congress right now, and that if it passes, we will go back to 100% depreciation. And if that's the case, instead of $27,000 for your 100,000, you're going to get 40,000. And that's retroactive. So that's like, if you invested in something last year where it was at 80%, you would be able to go back and claim the full 100%. So that it hasn't passed yet, but I will keep you guys posted. So what does all of this mean? It means that like all the cash flow that you're getting from this investment is tax-free. And that's a lot of investors are looking for that opportunity. And so to be able to bring it to you guys, I'm really excited about that. So market analysis. One of the things that we do at Phoenix is we do webinars, and we talk about kind of how we get this opportunity, how we go out, how we seek it, what location we're looking for. And so I will say one of the biggest things that we look for in where to acquire properties, location. Like we say location, location, location all the time. And so to be able to say like we are buying at a great location, it makes the deal even better. So I'll tell you guys this. A lot of my family lives in the Atlanta MSA. So live in Atlanta and right outside in a lot of the suburbs. And so the second I told them that I was coming to due diligence on this property, a lot of them know Gwinnett County, and some of them actually live in that county. They were like, oh, we're so in on this deal. And like, they're all investing in the deal. And so it just speaks to how powerful the location is. And with just how much people are moving into the county, we're behind on apartments. And so there's just a significant, like the supply is lagging behind renter demand. That is why occupancy is so high. And I think by 2040, it'll have almost 1.5 million residents. But on top of the location, even what makes it better is that there's just a great employer mix. So there's a lot of healthcare is there, Rivian plant is coming there, electric car, Amazon distribution is there. There's tons of economic drivers that are really making the county robust. And that's why it's going to be the largest county come 2040, which I think is in 16 years. So yeah, that's just like how to think about where we're looking for apartments. And then I talked about like in the years that we're owning it, even if we're assuming rent growth of 3%, while we own this property between 2024 and 2028, rent growth is projected to grow at 15%. So we are benefiting in the upside that comes with this market. And then I wanted to highlight schools even more. And one of our investors, a few years ago, she was leaving Nashville and she actually was moving to Georgia, and she picked Gwinnett County. really for Grove Parkview High School. And I'm sorry, for Parkview High School. That's just how amazing the school district is. And I've talked about it. And that's one of the reasons why we were really excited. Families are moving into the area, and that's why occupancy is so high. And I just want to talk about when we're looking for places to buy, median household income is very important. And if you look at the 1 to 5 mile radius of Grove Parkview, the median household income is between 89,000 and 108,000. So it's really an affluent landscape that's around Grove Parkview. And the average home value is 410,000. So the people who are moving there, who are living there as a way for him to start his passive investment journey and as a way for him to grow wealth, even to grow generational wealth for his kids. This is the power of what we're doing at Phoenix. And this is why I'm just excited to bring this opportunity to everyone here today. We're doing this as a team and as a group. And I wanted to take a second to highlight our partners in this deal. A deal this amazing and this robust. We are coming together to take it down. And I wanted to talk about Excite Capital as one of our partners. And Excite Capital is made up of Dr. Julius Oni, Leslie Awasom, and Tenny Tolafari. And these gentlemen are truly the definition of success. And I've said it before and I'll say it again, they really are trailblazers in the multifamily space. I met them over 2+ years ago, and they introduced me to multifamily real estate investing. And I invested as a passive investor in one of their deals. And that was how the journey started. And I realized that it's something that I wanted to bring to the Phoenix community. And I learned a lot from them. And so it's really amazing to almost come full circle to think that we're partnering together on this deal. It just speaks volume to the power of relationship, and more than that, to the type of people they are. So I'm excited to bring this to you with really, truly great partners. And then also part of our team is Chris Lento with EM Capital and Brad Kanjamila with Crest City Capital. And it really takes a team to get the job done. And that's how we got here today. And these two guys and their companies are just amazing. I cannot say enough great things about the entire team that we're working with. So I talked to you a little bit about our property managers in the beginning, and we are working with Asset Living. That's our property management team. And they are a national property management team, and they have a very, very strong presence in Georgia. We started with them from the beginning of this deal, and I saw them full force at due diligence. When we went there, they split us all up into teams, and we scrutinized every single apartment complex. But while we were doing that, there was another team that was looking at roofing, looking at landscaping, and there was even another team that was looking through every single rental contract. And so that what we are purchasing is what we're actually getting, and making sure that we're looking at every crawl space, every basement. And so to be able to see that in action was just truly amazing. But what's even more amazing is what testimonial by that investor, because he got to meet the actual on-site property management team. And that team they truly have 75 years of experience. And I met Miss Cynthia when I went to due diligence, who had been there for 20 years. She knew not every single one, but almost 90% of the tenants. She's known them because she's just been there for so long. She understands it. She understands what they want. And that's why the property and that asset is doing really, really well. So as we wrap up, this is our timeline. So subscription documents became available in June. Our deadline for going into the portal and signing it is July 31st, with a plan to wire funds by August 1st. Our tentative close date is August 7th. And so I just wanted to, for those of you who are ready to go, I wanted to give you this timeline, and I'll give you a QR code in a second. But so how does this work? You fill out all the documents, you log into the investment portal, and I'll tell you exactly what to do. Log into the investment portal, we'll walk you through it, you'll sign the PPM, and then you'll wire the funds, and then you just sit back and you just watch how your returns are working for you and how they're growing. So if you are ready to go, this is the QR code that you are going to just pull out your phone, scan the QR code, and all you're going to do is a simple step. In the top right-hand corner of the investment portal, you'll see a sign in. Click on that. I think it's your name, maybe email and phone number, name, email, and password. And then you'll create a profile. And after that, we'll take it from there. Someone from our team will reach out to you, will walk you through the whole process, will answer any questions. And right now, you have the QR code, but we're going to put the link in the chat as well. So what does it look like to come on board on this property? When you invest in this deal, you will be able to achieve those returns that I told you about, 15.5 to 18% average annual return, which means that if you're investing 100,000, you're getting about 15 to 18,000 a year while you sleep without any single effort on your part. But in addition to that, you will be getting monthly updates on how the property is doing. You'll see the financials, you see kind of everything that we're doing, how we're taking care of this property. You will then be getting quarterly distributions. And on top of all of that, you will become part of the Phoenix Capital investment community, and you'll get early access to all our future opportunities. Every deal that we go look at, we think about, you will know about it. You become part of the ownership group of this amazing institutional grade asset. And this will be your start. This will be the path to building financial freedom and generational wealth. So those are the things that you'll get when you come in on board with us on this amazing opportunity. I will also, if you have any questions, I said it before, put questions in the chat. I'd love to answer any questions. No question is small, or any question goes. But I will also put my calendar link in the chat. So if you want to schedule a call with me, if there's something that you want to delve a little bit deeper in the numbers, if you want to pull out a calculator, you and I can go through it together. I want you to be able to ask me that. So that will also be available. But as I wrap up, I just want to say thank you. Thank you for giving me the time to share this amazing opportunity with you. You have heard my story, and you heard how I began, and this is where I am today. So this also can be part of your story. This can be how you start to build generational wealth, how you start to build passive income. So I just want to say thank you, thank you, thank you. Okay, there are questions in the Q&A and there are questions in the chat, so yay. Can you break down the 50,000? So Jennifer, did you see, so the slide I put up, just divide everything by half. So it's the exact same number, it's just divided by half. That would be, the 100,000 was just like I said for easy math, but those numbers would be the exact same numbers for 50,000. Is the Class B class breakdown example you reviewed for 50,000? Yes, that is exactly it. We just use 100,000 across A and B so that it would be the same, but that is exactly it. You are right. FY asked, why is the seller selling? That's a great question. So the reason why they're selling is they have executed their business plan on this deal and they've done really well, but they're also as a group exiting. They're kind of doing something different with their portfolio. And so they're exiting a lot of their Georgia properties. And this is the last one. And so it was a great opportunity, but they have done significantly well on the deal. And that's why they decided to exit. And Brian said, what is the role of the 3 capital groups you mentioned in the presentation? So Brian, we are a team. So all of us, we don't all do equal things in the deal, but we are all equal partners in the deal. So we are all involved in asset management. We were all involved in the due diligence process and acquiring the property. We were all involved in the liquidity and in everything about the deal. So everything that we did it as a group. And so we're working together as a group. So in the asset management portion, after we close the deal, we're all in this together and we're making decisions. I hope I was able to answer your question. So I got a question from, is it too late to join as a non-accredited investor? So that is a great question. This deal right now, and I forgot to mention that, is for accredited investors only. And so what does an accredited investor mean? It means that you make $200,000 a year in income. You've made that in the last 2 years, and you think you're going to make that in the next year, or $300,000 with your spouse, or if you have $1 million in net worth, $1 million in net worth, that excludes your property and like any vehicle that you have. So that's what makes you an accredited investor. And this deal is for accredited investors. Now, so before this deal became public, because this is how, we got to bring it to all of you who are on the webinar today, before we got to bring this deal, it was a 506B deal. So it was for our community, and it was for non-accredited investors at that time. Anyone could invest, but really we were targeting non-accredited investors because we want to be able to bring opportunities like this to our community. And we realize that we have savvy investors who really understand what real estate investing is and might not meet that criteria to be an accredited investor. So we actually made this deal available to them before we went public. But the second we went public with a deal, it had to become a 506C deal, which means that it was only for accredited investors. And then I got another question. Are there any other ways to invest other than cash? Yes. So you can, of course, invest cash, but if you don't have that, you can invest with a self-directed IRA. So if you have, money through your employer and convert that to a self-directed IRA, you can actually invest with that. And that is a great opportunity for some investors. And then you can also invest with your business and LLC. And so those are some of the ways that you can invest other than cash. James asked, was there a period where non-accredited investors could invest? Does every deal have that window? So yes, James, I just answered that. Not every deal has that window, but I do realize that at Phoenix, not all our investors are accredited investors. And that's one of the questions that I ask when I first meet with you and kind of know what your business, what your goals are and how we align together. And so because I knew that not every investor is an accredited investor, I tried to make all our deals have that period where non-accredited investors can come into the deal, but it's a very short time. So it's like a period of 2 to 3 weeks, and sometimes less, but they have already built a substantive relationship with us at Phoenix. So they know, so when the deal comes out, like they know that as soon as they review it, do due diligence, they're ready to jump in. So, and like I said, if that's you, just like reach out. I'd love to meet with you, love to chat with you, and then we can go from there. So the plan is to exit the deal in 5 years. That is our plan right now. And that is based on, when we acquire these property, it takes about a year or two to really stabilize it. So I showed you the robust plan that we wanted to do for value add and for renovation. So it takes about a year to two to really stabilize the deal. And then from that, we're managing it. So right now, our goal is to hold the deal for about 5 years. If that were to change for one reason or the other, we will let our investors know. To kind of go a little bit further in that question, Chi, is if we are constantly looking at the market and we're constantly evaluating the market. So if, the market is booming and in a year or two, or even 3, we notice that the market is doing really, really well, and maybe it might be a really good time to sell, so that our investors can get the returns that we promised, or even better, then we will make that decision as a core group, as an operating group, and we'll let our investors know. But that's something that we're thinking about. We're constantly talking to the brokers to get what we call a broker opinion of value. So to let us know like what the market is doing, what these are going for. And as we improve the property, we'll also, we're force appreciating it. So we know that the property is going to do well. But that's how we're thinking about it in the time frame. But when we tell you we're going in at a holding for 5 years, I was under the impression that deals want to accredited investors because they have higher buying power. Is there a reason this is restricted to accredited I'm assuming you say non-accredited investors. Is there a reason this is restricted to accredited investors, but they also have a $50,000 buy-in? So the reason why, and I'll explain this to the best of my ability, the reason why is that this is a significant amount of capital investment that investors are bringing. And so the thought behind it is that as an accredited investor, you are educated, or maybe you're more educated and understand your finances a little bit better. And also, this is not money that you are dependent on for your daily needs. That's why the rule is that, that's why accredited investor was created. And that's why that is what we use. So I hope that answers your question. But yes, it's the same 50,000 buy-in. But there's something, I'll tell you 2 things, Ify, and I'm glad you asked this question. One is, like I said, there's that period for non-accredited investors who are savvy, who understand deals like this. But also, it's coming out, and I think maybe it's already out, but there's a test that you can take. And I will find out all the details because I noticed this is third question that has come up about this. So I will find out all the details about it, where there's something that you can take to qualify you for to be an accredited investor. So I might do that as like our next blog or our next post that I send out, so that I'm able to educate our investors. Okay, Jennifer said, can you explain investing with an IRA, not cash? Isn't it all cash? It is, but it's another. So instead of it sitting in that account, you can use that and invest. So you can invest like your self-directed IRA. So the money that's coming in from your employer, you can invest that into the deal. When we sell, the money goes back into your IRA. So you're, as opposed to pay cash, then the money's coming back to you. So that's also an opportunity. But yes, it's your money and it's just going back into that vehicle. Do you have a preferred self-directed IRA or partner that we work with? Great question. If I will reach out to you, and I'll actually, when I send out the recording, I'll put a list. There are 2 companies that we have vetted and that we want to tell all our investors to use, those who have a self-directed IRA and who have that opportunity. So I will make sure that you get that information. The distribution payments made quarterly or annually? Great question. So our distributions are quarterly right now. You start getting distributions every quarter. The goal, our hope is that eventually we'll be able to distribute monthly, but right now it's quarterly and we don't do annual basis. So so as we get cash flow, it's coming out to the investors. Margaret, hi Margaret. Margaret says, what happens if you do not have a buyer in 5 years for exit? Margaret, that's a really, really, really good question. So a couple of things that we think about, and I want to be able to kind of help answer that question, are 2 things. Well, I remember in a slide that I talked to you about location. So Atlanta is a great market. And when we look at these opportunities that we want to buy, we have the exit in mind. So we are buying in locations that we know that in 10 to 20 years, there will still be a demand for this business and for this opportunity and this exact sample that we're doing. And so that is how we think about it. So we are constantly looking, and we have really evaluated the market, and it is a strong market. What I talked about is that demand is outpacing supply. People are moving there. They need a place to stay. Housing is a commodity. And right now, with what's going on with interest rates, home buyers are like, they're getting priced out. And so they truly need a place to live. They're resorting to apartment complexes. And like I said, based on the fundamentals, the Georgia market, even the submarket Gwinnett County is like thriving. And that will be the case for about the next 10 to 20 years. So that's something that we've thought about, and we factor it in even at time of purchase. But then what if we don't exit in 5 years? And that's a question, and that is a reality. And right now, our plan is that we'll refinance the property. And so we will do a cash out refinance, where then we will give investors a portion of the money invested, and then we'll continue with a deal. So that's something that we always have to think about, and we always have to keep in mind. Right now, based on the plan going in, that's what we're doing. Is there a specific procedure for becoming an accredited investor? If I asked. So if you just qualify. So if you meet the criteria that I said, which was $200,000 as single, or $300,000 as a couple, or $1 million in net worth that excludes your house, your private residence, and any automobiles that you might have, you qualify. So what you would just need to do is have your CPA accountant write a letter just saying that, yes, you qualify, and that's all it takes. So it's not a rigorous process at all. Will investors ever owe money other than what's initially invested? Takaria, that is a great question. So that's a really, really good question. And you guys, the questions are fantastic. So we are going right now, the only initial investment that we're asking for is the initial investment of $50,000. But I do want to say that this is a risk. And with with taking calculated risk, you're going to get returns, the returns that I told you about. But we don't know, we can't predict exactly what's going to happen in the market. We can only kind of assume based on some of our assumptions that we're making and what we've seen. But if there's something were to be wrong with the deal, there's a chance that we could do something called a capital call and ask for more capital. But right now, a lot of that happened in the past where a lot of real estate investment firms were buying these deals with something called bridge debt. And so these debts were on a floating interest rate. And so it wasn't fixed. We are buying on a fixed interest rate at 4.7%. And so because when you bought with bridge debt, with what has happened in the interest rate market in the last 2 years, some of these firms bought at an interest rate of like 2%. And now the interest rate is around 7 or 8%. And that's because it just kept going up and they didn't buy something called a rate cap to cap that interest rate. And so right now they can't pay debt. And so they're having to ask investors to bring in more money. But we truly went in to this deal and underwrote it conservatively with fixed rate debt. And so the likelihood of that happening is slim, but can it happen? Yes. I once again want to say thank you. If we could put the link one more time in the chat. So if anyone wants to jump in to just get on the portal and sign up, we will be in touch with you and then we can go from there. But I just wanted to say thank you once again for everyone who joined in. I hope that you jump in and join us on this investment opportunity.